ExxonMobil just reported a 45.8% crash in net income, and Wall Street called it a win. Chevron posted a 24% surge in US production, and analysts started asking whether the dividend is safe. How can both companies look like disasters on paper while telling completely opposite stories about their financial futures? Here is what you need to understand before you make a single decision about either of these stocks. Q1 26 is one of the most optically misleading quarters in modern big oil history. Both Chevron and ExxonMobil reported collapsing earnings. That is, earnings calculated under the standardized accounting rules every public company must follow. Both saw free cash flow fall off a cliff. Both are paying out more to shareholders than they are generating in profit. And yet, beneath that identical-looking surface damage, these two companies are telling fundamentally different stories. ExxonMobil generated total revenues of $85.14 billion in Q1 26. Chevron generated $48.61 billion. That is not a competitive gap. That is a structural canyon. ExxonMobil is operating at nearly 1.75 times the revenue scale of its closest American rival. But scale cuts in both directions. Both companies grew revenue at nearly identical rates. ExxonMobil up 2.4% year over year, Chevron up 2.1%. Same commodity environment, same headwinds. And yet, ExxonMobil's total asset base of $464.4 billion versus Chevron's $329.5 billion gives ExxonMobil a structural shock absorption capacity that Chevron simply cannot replicate. Think of it this way. In the energy sector, where a single quarter of commodity price volatility can inflict a $4.63 billion working capital outflow, as it did to Chevron this quarter, the size of your financial fortress is not a vanity metric. It is a survival advantage. Now here is where the analysis gets genuinely fascinating and where most investors make their most expensive mistake. On a GAAP basis, both companies look catastrophic. ExxonMobil's net income fell to $4.18 billion, down 45.8% year over year. Chevron's net income dropped 36.9% to just $2.2 billion. ExxonMobil's operating margin fell to 8.2% from 13.9% the prior year, while Chevron's compressed to 8.1% from 11.7%. On the surface, they look almost identical in their pain. But peel back one layer and the divergence becomes dramatic. ExxonMobil's earnings strip out a $3.9 billion estimated timing effect from unsettled financial derivatives and $706 million in identified one-time items. A derivative, in simple terms, is a financial contract whose value is tied to a commodity price. And when that price moves before physical delivery is completed, it creates a temporary paper loss that distorts the reported number. Once those adjustments are removed, ExxonMobil's underlying earnings come in at $8.8 billion, a figure that actually increased year over year from $7.6 billion. Beneath the disaster, ExxonMobil's underlying business grew. That extraordinary detail is completely buried by the headline number, and this is something you can check for yourself in any quarterly filing, right in the earnings reconciliation tables. Chevron's adjusted earnings tell a far more modest story, $2.8 billion, after removing a $360 million after-tax legal reserve and $223 million in foreign currency losses. ExxonMobil's underlying earnings power exceeds Chevron's by more than 3 to 1. On a non-GAAP basis, ExxonMobil's true underlying earnings margin runs at approximately 10.3%, more than double Chevron's adjusted figure. GAAP tells you what happened on paper. Non-GAAP, when used carefully and honestly, tells you what is actually happening in the business. Now we reach the chapter that should concern every Chevron shareholder. Chevron reported negative free cash flow, the cash left over after all operating costs and capital investment are paid, of negative $1.55 billion in Q1. Not compressed, not reduced, negative. Operating cash flow cratered 51.5% year over year to $2.5 billion, against capital expenditures of $4.1 billion. And yet, simultaneously, Chevron distributed $6 billion to shareholders, $3.5 billion in dividends, and $2.6 billion in buybacks. Every dollar of that excess was funded by a net $4.6 billion increase in debt. The dividend payout ratio, the percentage of net income paid out as dividends, sits at 159%. Chevron is, functionally, borrowing money to pay you. That statement deserves to land. ExxonMobil tells a rhyming but critically different story. It distributed $9.2 billion to shareholders while generating only $2.70 billion in free cash flow, bridging the gap through $9.08 billion in commercial paper, essentially short-term borrowing. Its dividend payout ratio also exceeds 100%, at 104%. Both companies are running hot, but ExxonMobil's debt-to-capital ratio remains at an industry-leading 15.4% against Chevron's debt-to-equity ratio that has climbed to 24.7% and is trending upward. ExxonMobil's operating cash flow of $8.7 billion, even in its worst recent quarter, is more than 3 times Chevron's $2.5 billion. The investing strategy implication is direct. Both companies are stretched, but ExxonMobil has the balance sheet runway to absorb it. Chevron is approaching a decision point. Now let's talk production, because this is where Chevron makes its most compelling argument. A 15% worldwide production increase, a 24% surge in US production, refineries exceeding 1 million barrels per day for the 5th consecutive quarter. Genuinely impressive numbers. But the source of that growth matters as much as the growth itself. Chevron purchased its way to these gains through recently acquired legacy assets. Integration risk is real. Legacy assets carry legacy costs, legacy liabilities, and operational inefficiencies that take years to optimize. ExxonMobil's production growth has a completely different DNA. Guyana set a new quarterly production record exceeding 900,000 gross barrels of oil per day. A world-class low-cost deepwater asset that ExxonMobil discovered and built from scratch. The Permian Basin continues delivering high-margin volume at scale, and the Golden Pass LNG terminal achieved first Train 1 production, adding export capacity representing approximately 5% of national LNG export volumes relative to 2025. These are purpose-built engines reaching operational maturity simultaneously. For your portfolio, organic growth reaching full capacity and acquired growth still being digested are 2 fundamentally different investment propositions. This is fundamental analysis at its most practical. Now the hidden fault line. Chevron's international downstream segment swung from a $222 million profit in Q125 to a $1.01 billion net loss in Q126. A $1.23 billion deterioration from a single segment in a single quarter. Is this cyclical pain or structural fragility? ExxonMobil's energy products segment also posted a loss of $1.26 billion. But on a non-GAAP basis, that same segment generated $2.8 billion in earnings, meaning the reported loss is almost entirely an accounting artifact. Chevron has no equivalent bridge. Its downstream loss is operationally real. As an investor applying value investing principles, that distinction defines your entire risk exposure. The cost discipline battle seals the verdict. ExxonMobil has accumulated $15.6 billion in cumulative structural cost savings relative to 2019 baselines, with $0.6 billion saved in Q126 alone, on a committed trajectory toward $20 billion by 2030. Chevron provides no comparable cumulative figure. The measurable outcome is stark. Chevron's operating cash flow fell 51.5% year over year. ExxonMobil's fell 32.8%. Same market, same pressures. A 19 percentage point difference in cash flow resilience is not noise, it is signal. ExxonMobil is the superior investment right now. Not because it had a better quarter, but because it is a better architected company. When markets normalize and that $3.9 billion timing distortion reverses, ExxonMobil's earnings rebound will be dramatic. Meanwhile, Chevron must fix its free cash flow, stabilize its downstream, and reduce leverage, all before the market fully prices in the reality that a 159% dividend payout ratio funded by debt is not a shareholder return program. And this is the part that most people never reach. Not because the information is hidden, not because you need a finance degree or a Bloomberg terminal or 20 years of experience on a trading floor, because knowing what happened is only half the equation. The half that actually changes your life, the half that separates the people who watch history repeat itself from the people who see it coming, is understanding why it happened. The mechanism underneath, the incentive that was misaligned, the risk that was mispriced, the assumption that felt safe until it wasn't. That is what we just broke down together. And that framework, that way of reading a situation, does not expire when this video ends. It travels with you. Into the next financial video you scroll past on your phone, into the next conversation about whether now is a good time to buy or sell or wait, into the next headline designed to make you feel something before you have had a chance to think anything. Into the next decision, big or small, where someone is counting on you not knowing what you now know. Here is the truth that every story we cover on this channel keeps pointing back to. Money does not move randomly. Markets do not collapse randomly. Companies do not fail randomly. People do not end up broke randomly. There's always a logic underneath, always a sequence of decisions, incentives, and miscalculations that, when you see them clearly, make the outcome feel almost inevitable. The tragedy is never the collapse itself. The tragedy is that the signals were there the entire time. Visible, readable, understandable, for anyone who knew what to look for. Whether we are talking about a trillion-dollar empire, a housing market on the brink, or the way a single household manages its monthly budget, the laws of gravity remain the same. You cannot build a skyscraper on a foundation of sand, and you cannot build a future on a foundation of financial illiteracy. That is the only edge that actually matters in the long run. Not a hot stock tip, not perfect market timing, just the ability to read the room before everyone else does. It is about shifting your perspective from being a passenger in the global economy to being someone who can actually read the map. Because when you understand the map, the scary headlines lose their power over you. You realize that most of the noise is just that. Noise, designed to keep you reactive rather than proactive. In the world of finance, the most expensive thing you can own is a closed mind. Most people lose money not because they are unlucky, but because they are operating on outdated maps. They are playing a game where the rules changed 10 years ago, but they are still following the old guidebook. By looking at the specific case study we discussed today, you've essentially just updated your software. You've seen how the gears turn behind the curtain. And once you see the machinery, you can never go back to just believing in the magic trick. The path to real wealth isn't paved with complex algorithms. It's paved with the patience to learn and the courage to act on logic when everyone else is acting on emotion. It's about recognizing that every financial disaster and every massive success is just a human story told through numbers. So if this video sharpened something, if it made one concept click that was blurry before, if it gave you one framework you will carry into a real decision, then you already know what to do next. Take that insight and apply it. Don't let it sit as entertainment. Use it as a lens. The next time you see a company skyrocketing or a market dipping, ask yourself, what is the underlying incentive? Who wins if this continues? Who is carrying the risk that no one is talking about? True financial wisdom isn't about knowing everything. It's about knowing how to think about everything. It's about building a mental fortress that protects your capital and your peace of mind. So hit subscribe so you won't miss what's next and jump straight to the next video, because that could be the very insight you need to get ahead.